How is everybody doing? Welcome to the Strategy Room. It is Saturday night, March 29th, 2025. I hope everyone is having an awesome weekend out there. I can't wait to get rolling here tonight. I've got literally a million stories, a million things to go over with everybody. And we got so much to go over here tonight. So, okay, let's get started here. I'll tell you what, we'll get started here as we usually do with our Doge clock. Just check it in and see how we're doing here with the good fine Doge people. So we're up to about $257 billion on the Doge clock, approximately $2,294 savings per taxpayer. So that is fantastic. Love to see it. Still really no movement in our federal budget deficit. National debt continues to tick up. So nothing really changing there. I really wish I could say that those numbers were changing, even if it was just a tiny little fraction of a number, anything. But no, we're still there. So, but like I said, Doge is still rolling good. 257 billion, $2,294 per taxpayer. Not too shabby. So love to see that there. And now we'll go on, get into some. So I figured we'd start with this. We'd take a look at the debt clock real quick, and then we would go right into this. So think the national debt is big now. Wait until the Trump tax cut extensions hit. So what are some of the key takeaways here? So extending President Donald Trump's 2017 tax cuts would push the national debt to more than twice the gross domestic product by 2054, the Congressional Budget Office said in a recent estimate. The nation's finances would hit a tipping point into a severe financial crisis if the debt ever got as high as 200% of the GDP, researchers at Wharton estimated in 2023. The CBO's estimates assume the tax cuts are extended without a decrease in federal spending to make up for it. Republican lawmakers are currently working on a budget for next year that extends the tax cuts and slashes federal spending, including Medicaid. Hang on for a second, because I got news for the lovely people at Wharton. They predict that our nation's finances would be at a tipping point if, wait for it, and we would be in a severe financial crisis if the debt ever got as high as 200% of GDP. So let's take a look at this. If we could see this number, I know this is kind of hard to see up in the upper left-hand corner here. Our federal debt to GDP ratio now stands at 122.57%. Okay, that is insanely high right now as it stands. We are in a crisis right now as this is. I would point out to the lovely people at Wharton that any developed country that has a debt to GDP over 105%, okay, you're basically done. You're beyond bankrupt. Okay, you are in a wretchedly horrible place, and that is where we find ourselves right now, this very minute. We don't need to get to 200% because we're already there. So I just wanted to say that. Just wanted to point out that little gem there up there front. Okay, but I think, and I wanted to point this out because I think this starts a fantastic conversation, because the first thing to point out is that I think the Republicans recognize that, yes, they're not just going to be able to push back through all the 2017 tax cuts as they currently stand. Now, wait for it. I think what they're going to try to do is something that we haven't seen done maybe in our lifetimes, and that is they are going to look to increase taxes on the rich and decrease taxes on the poor and the middle class. As amazing as that sounds, that I think is going to be their strategy here. That is how they're going to make up the difference, which is great, because I think that a lot of the billionaires should be paying more tax in certain regards. Again, if you are, I'll put it this way, from a pure tax perspective, they have this thing called passive income. In other words, most working people, they're either 1099 employees, meaning they're like subcontractors and they pay their own taxes out of their pocket, or they are W-2 employees, meaning that they work for a company, small business, or larger corporation, whatever, but they get a W-2 at the end of the year, and they take that W-2 or they take that 1099 and they go file their taxes. Well, for most of the uber rich, especially people like that, hedge fund managers, private equity managers, all this kind of stuff, they don't make W-2 or 1099 income. They make what's called passive income. And passive income is basically money that just gets paid out to them at certain points throughout the year, and they are able to pay. Basically, it's basically like long-term and short-term capital gains on it. It's treated like a capital gain as opposed to like regular, working income. So therefore, they're able to finagle a way that they pay a lot less in tax on that passive income. And that, I think, is a huge problem. That's something that needs to be stopped. If you're making if you're making $50,000 a year and you're paying Uncle Sam 30% in taxes, and the guy making, the hedge fund manager making $80 million a year is only paying a 14% tax rate. Now, to be fair, on a dollar for dollar basis, that hedge fund manager making 80 million bucks, he might only be paying 14% as opposed to 24%. But on a dollar basis, he's paying like 10 times more in taxes than that person who's making 80,000. So I just want to put that out there. So just point that fact out. They are paying a lot more in taxes than your average person on a dollar basis, but on a percentage basis, they're getting one over on us. And I think so if they can address that. Now I will remind everybody, I don't know if anybody remembers this. There was a senator, Democrat Senator Christine Sinema, who was out in Arizona. And Christine Sinema, about a year, maybe 2 years ago. So the Senate was working on a bill, and she wanted to put a major tax increase on billionaires in this bill. She had included it as a part of the bill. And basically all the billionaires got together, or at least a lot of them, and basically said, oh, no way. And they went back and they took that out of the bill. And it was so bad that not only did they take it out of the bill, it basically ended Christine Sinema's political career, because she basically got ran right out of the Senate. 2 years later, she's gone. And so, like I said, so it'll be interesting to see, what happens with that and if that's something that can actually come to pass. But I think everybody realizes that there's no way that the Donald Trump tax cuts for 2017 can just be extended verbatim. I think there has to be some give and take there. And I think the way that they're going to try to solve it is by putting more tax on the wealthy, so to speak, particularly billionaires, and less tax on your middle class and your lower income individuals. So we'll see. Hopefully that is the case. We shall see, but we'll, see what happens there. So, all right, let's look at some economic indicators that came out this week. So I got a couple things here for you. We're going to start with this one right here. So consumer confidence in where the economy is hits 12-year low. Doesn't sound great, right? So the Conference Board's measure of future expectations tumbled 9.6 points to 65.2, the lowest reading in 12 years. The board's monthly confidence index of current conditions slipped to 92.9, a 7.2-point decline, and the fourth consecutive monthly contraction. So consumer confidence dimmed further in March as the view of future conditions fell to the lowest level in more than a decade, the Conference Board reported on Tuesday. However, the measure for future expectations told an even darker story, with the index tumbling 9.6 points to 65.2, the lowest reading in 12 years, and well below the 80 level that is considered a signal for a recession ahead. So the index measures respondents' outlook for income, business, and job prospects. Consumers' optimism about future income, which had held up quite strongly in the past few months, largely vanished, suggesting worries about the economy and the labor market have started to spread into consumers' assessments of their personal situation. So this is interesting, and we're gonna build on this like a snowball tonight. So just hang in there with me, because we're gonna look at a couple. Let's get through a couple more of these indicators, and then I'm going to show you an article on basically a survey that was taken and people's thoughts on a potential recession coming up. So just hold these things in the mind for just a minute here. So we're going to continue rolling on here. So Now, so we just did consumer confidence. Now we're going to do consumer sentiment. So consumer sentiment worsens as inflation fears grow, University of Michigan survey shows. The final version of the University of Michigan's closely watched survey of consumers showed a reading of 57 for the month, down 11.9% from February and 28.2% from a year ago. Inflation fears drove much of the downturn. Respondents expect inflation a year from now to run at a 5% rate, up 0.1 percentage points from the mid-month reading and a 0.7 percentage point acceleration from February. Now, let me ask you this. Why do you think people have, now again, this is a survey, so why do you think consumers feel that inflation is going to be up? It couldn't have anything to do with the fact that every single publication in the mainstream media, whether it would be the Wall Street Journal or Bloomberg Business or CNBC, everybody's telling you that the tariffs are going to drive this massive inflation. So I do believe that the narrative being put out by the news media is heavily influencing this basically fear gauge of inflation right now. So, and I would say this from an inflation standpoint, a recession would actually be a great thing from a recession standpoint because it would slow everything down and it would basically kill the inflation. It would bring the inflation down. Now, do we want a recession? No, not necessarily. We don't really want that because that, people might lose their jobs. People's incomes don't go up when you have a recession. People continue to struggle a little bit. So we don't necessarily want that. However, there are potential positives to it. Like, the price of a lot of goods would come down. Price of rent might come down just a tad, not a ton, but it might at least ease off a little bit. And that in and of itself might actually help a lot of people out there. So, but again, I'm like I said, I'm a little slanted on the consumer sentiment here a little bit because I don't think that this is perhaps giving the proper view of things right now. I think there are other things that may lead to this, but I don't think that, just this is basically just showing you there's an overblown fear of inflation out there right now. And I think it's, and it is because the media makes it so with the narrative that they pump out. So, okay, let's see here. Core inflation in February hits 2.8%, higher than expected, and spending increases 0.4%. So the core personal consumption expenditures price index, a key Fed inflation measure, showed a 0.4% increase in February, putting the 12-month inflation rate at 2.8%, both higher than expected. Now, what they call the PCE index. This is the Fed's preferred inflation index, as opposed to what the other indexes that we look at, the CPI and the PPI. I like to look at kind of all three together and make a kind of assessment based on what all three are doing. I don't like to just pick any single one per se, but this, like I said, this is the one the Fed likes. They look at this one. And so this is obviously influencing their thinking here right now. So basically saying, hey, this is still coming in a lot higher, 2.8%, which is the core number, 2.8%, a lot higher than what the Fed is looking for right now. That is for sure. Consumer spending accelerated 0.4% for the month, below the 0.5% forecast. That came as personal income posted a 0.8% rise against the estimate for 0.4%. So the Federal Reserve's key inflation measure rose more than expected in February, while consumer spending also posted a smaller than projected increase, the Commerce Department reported on Friday. So core inflation excludes volatile food and energy prices and is generally considered a better indicator of long-term inflation trends. In the all items measure, the price index rose 0.3% on the month and 2.5% from a year ago, both in line with forecasts. At the same time, the Bureau of Economic Analysis report showed that consumer spending accelerated 0.4% for the month, below the 0.5% forecast. That came as personal income posted a 0.8% rise against the estimate for 0.4%. Federal Reserve officials focus on the PCE inflation reading as they consider it a broader measure that also adjusts for changes in consumer behavior and places less of an emphasis on housing than the Labor Department's Consumer Price Index. Shelter costs have been one of the stickier elements of inflation and rose 0.3% in the PCE measure. It looks like a wait and see. Fed still has more waiting to do, said Ellen Zettner, chief economic strategist at Morgan Stanley Wealth Management. Today's higher than expected inflation reading wasn't exceptionally hot, but it isn't going to speed up the Fed's timeline for cutting interest rates, especially given the uncertainty surrounding tariffs. So yes, I don't necessarily disagree with that. But as I said last week, Jeremy Powell, what Jeremy Powell told you in this Fed meeting that he had last week is basically, he's not going to do anything to help us. Jeremy Powell is sitting on the sidelines, and that's his stance right now. He is not going to lift a finger to help anybody because he is in full on pout mode. But I do have some good news for him. That good news is coming in just a minute. You just sit tight. I got something for you. I won't disappoint. Okay. The mortgage demand from home buyers is strongest in nearly 2 months, but that's not saying a lot. So applications for a mortgage to purchase a home rose 1% for the week and were 7% higher than the same week 1 year ago. The average rate on the 30-year fixed mortgage dropped to 6.71% from just 6.72. Applications to refinance a home loan decreased 5% from the previous week to the lowest level in a month. So, yeah, I guess there's good and bad in this. Again, there's still some activity there. Mortgage rates aren't horrific at 6.71%. Certainly you'd like to see them, down, I would say sub 6. I'd say somewhere in that 5 to 6% range would be more ideal right now. But again, not terrible. And as long as they don't go back up over 7%, not the worst thing in the world. It just says here, mortgage rates barely budged last week, but home buyers may be inching back to the market despite strong spring headwinds. Refinance demand was weaker, however, pushing total application volume down 2% last week from the previous week, according to the Mortgage Bankers Association's seasonally adjusted index. Markets remain focused on potential trade policy changes while the Fed held the funds rate at its current level. So there you go. All right. Over 9 million student loan borrowers passed due after bills restarted, the Fed estimates. So around 9.7 million student loan borrowers became past due on their bills after the COVID-era payment pause expired, according to a new estimate by the Federal Reserve Bank of New York. So around 9.7 million student loan borrowers became past due on their bills after the COVID-era payment pause expired, according to a new estimate by the Fed Reserve of New York. After the COVID-era pause on federal student loan payments lapsed in September of 2023, the Biden administration offered borrowers a 12-month on-ramp to repayment. During that time, borrowers were shielded from most of the consequences of falling behind on their payments. That relief period concluded September 30th, 2024. By the end of the off-ramp period, the New York Fed estimates that the volume of past due federal student loans hit 15.6%, with more than $250 billion in delinquent debt. According to these numbers, it is reasonable to expect student loan delinquency to surpass pre-pandemic levels when new delinquencies hit credit reports, the Fed says. Now, I might have an episode coming up this week where I give an update on consumer credit reports, and I might talk about this a lot as part of what's going on in that episode. So you might want to check in on that episode, and I got into this whole subject a little bit more in detail. So, but again, this is, I point this out just because it's not good, right? It's another facet of all the things going on here, unfortunately, another not so great piece of news, coming out there. But I will put a caveat on this. While this sounds bad, I have maintained for a very, very, very long time that the student loan numbers being reported have been heavily manipulated. In other words, delinquency has been heavily manipulated. I think that if the government was accurately reporting the delinquency on student loan debt for the last 20 years, we probably would have had delinquency somewhere in the 10 to 20% range. But the federal government plays a lot of games. They make what's called forbearance agreements, very easy. They adjust loans to make them what's called, they give them negative amortization, which means that, you stop making the loan payments or you can't make the loan payment. That's fine. They're not going to mark it as delinquent. What they're going to do is they're just going to take that loan payment and they're just going to add it onto the back of the loan. And thus negative amortization meaning that the loan is growing as you're not paying that bill. So you're just every month you don't pay that bill, you're just digging yourself a bigger hole. So there are things like that have been going on for a very long time. So, but again, this is not good. And the reason why I look at this is really not good because it's like a snowball in a sense, right? The snowball starts running downhill, it gets bigger, it picks up steam. So in other words, if you have a young person who's in their 20s, right, and they're tapped out on their credit cards, don't have a lot in savings. Maybe they had to buy a car. Cars are a lot more expensive than they were 5 years ago. So now they had to get a car so they could get to and from work. And now they got the student loans kicking back in. What it's going to do is that it's going to bury them for a little while until they can get more experience and hopefully advance in their career and start making a little bit more money. Things get a little bit better. They can start affording their bills. But what it's going to do is it's going to push everything back. So in other words, that person, getting married, starting a family, buying a house, settling down, all those things are going to get pushed back. And, so you're going to have people, we already have people getting married and starting families later in life and buying houses later and, into their 30s and stuff like that. And we already have X amount of the population who I would say some older millennials that are in their, let's say, or early 40s at this point that are basically saying, forget it. I've never owned a house. I'm just not going to own a house. I'm never going to buy one. And, that's a big problem. I look at that as that is a massive problem because buying a house, irregardless of how big the house is, buying a house and just, making that payment every month and building up equity in the house over time, that is a huge part of it. Becomes a huge component of your retirement savings, believe it or not. And again, if you do it the right way, if you buy a house and you pay that thing off over time, and even if you buy a couple of houses in your lifetime, even if you go and you buy a house, get a bigger one, you buy a starter house, you sell it, you get a bigger one, maybe you get another one a couple of years after that, whatever. So even if you move a couple of times and you kind of get, bigger houses, whatever, you're still going to be paying down mortgages over time, and you're going to be building equity in those houses. And that equity someday, somewhere is going to pay off for you, whether or not you sell it to downsize, whether you sell it because it's time to go into the home, whatever the case, you're building equity that in some way, shape, or form is going to help you out one day. And it's going to add to, your retirement, benefits, your Social Security, maybe your 401k, your pension, whatever. So, but if you don't have that's equity there that you're never going to build and you're never going to tap. So I see that as an issue, big issue. Okay. Federal Housing Agency announces that they will not cut Fannie Mae and Freddie Mac loan limits per the new director. So I think that's good. Nothing wrong with that. So there are no plans to do anything as it relates to the conforming loan limit, said Bill Pulte, the FHFA director. It currently stands as $806,500, an increase of $39,950. Or 5.2% from 2024. So the newly confirmed director of the Federal Housing Finance Agency, Bill Pulte, who oversees mortgage giants Fannie Mae and Freddie Mac, said he will not lower the conforming loan limit or the maximum value for the loans the two firms will buy and guarantee. That limit is calculated each year according to current home prices. There are no plans to do anything as it relates to the conforming loan limit, Pulte said on Tuesday. The Trump administration has touted plans to reduce the federal government, and many have expected it will work to shrink the size of Fannie Mae and Freddie Mac. The mortgage giants guarantee the vast majority of the nation's $12 trillion mortgage market. Yeah, but that doesn't have anything to do with the, with basically the conforming mortgage rate, or the conforming loan limit or the maximum value for the loans. Like that one doesn't have anything to do with the other. But again, they're just keeping the loan limit steady. That's good. Nothing wrong with that. That's not going to mess with, conforming mortgages or getting jumbos or anything like that. So, so again, just some good news there. Okay, here is, now that we looked at those number of items, now here is the recession piece that I was talking about. So recession is coming before the end of 2025. Generally pessimistic corporate CFOs say, according to a CNBC survey. So the economy will enter a recession in the second half of 2025, according to a majority of chief financial officers responding to the quarterly CNBC CFO Council survey. CFOs describe themselves as generally pessimistic on the overall state of the U.S. economy and uncertain about the stock market. 95% of CFOs said policy is impacting their ability to make business decisions. And many said while Trump is delivering on promises, his administration's approach is too chaotic, disruptive, and extreme for businesses to navigate effectively. So, and all of those companies just coincidentally happen to be in California and New York. I kid. So it says here, the stock market experienced a relief rally to start the week as comments from the Trump economic team over the weekend suggested a softer stance on tariffs, but attempts to keep the comeback going fizzled out on Wednesday as Trump prepared to announce new auto industry tariffs. As it was within the boardroom, hope was not likely to replace caution anytime soon. Many executives in the C-suite and across the economy remain disturbed about the trade war outlook and a White House that has given every indication it is ideologically committed to a major change in global economic policy. Shifting messages from President Trump that continue to add confusion to the tariff planning process haven't helped. All right. Again, I laugh at this, this all this Chicken Little talk, like the tariffs, the world is falling, the world's going to end because we have these tariffs. I think in a year from now, people are going to be talking very differently about these tariffs. People are going to be saying, "Oh my gosh, these tariffs worked out way better than we thought. Look at all the jobs coming back to America. Look at all the investment coming in." In case anybody didn't see, companies have already committed to $2.9 trillion worth of investment back in the United States over the next 2-3 years. $2.9 trillion. How many U.S. jobs is that going to create? Thousands and thousands and thousands of U.S. jobs are going to be. And we're talking good jobs. We're not talking working at Walmart. We're talking good jobs. And I will say it's very telling that, so let's take the auto industry, for example. So while the heads of maybe GM or Ford may not have been ecstatic about this, but the United Auto Unions workers were elated because they're going to be hiring more people now. Why? Because there's going to be more production of vehicles in the United States, not just the U.S. automakers, but especially companies from Japan and from South Korea and from Europe they're going to start to move more of their production back here to the United States, which means, guess what? More auto worker jobs means more members for the union. Okay. So of course they love it. The irony there is that it was a Republican that delivered that for them and not a Democrat. That's very interesting. So let's continue on here. So the Treasury Department is set to lay off a substantial number of employees, officials say. So the Treasury Department is planning to furlough a substantial level of its workforce in conjunction with Elon Musk's efforts to shrink the size of the federal government, according to a court document. As part of a complaint in a related case, Trevor Norris, the department's Deputy Assistant Secretary of Human Resources, indicated that the layoffs will be coming as part of the Department of Government Efficiency's ongoing moves to cut the federal employee rolls. In a sworn statement, Norris said the Treasury is wrapping up plans to comply with President Donald Trump's executive order backing Doge's activity. The Treasury currently has more than 100,000 employees. These plans will be tailored for each bureau and in many cases will require separations of substantial number of employees through reductions in force, RIFs. let me just ask people a question. You have 100,000 employees there, right? So if we reduced that number by 10,000 and we got down to 90,000 employees, do you think anybody's going to notice? Do you think it's really going to affect things that much? I don't. I don't think for a second. I think you could cut 30,000 employees out of there. I think you could let 30,000 people go there. I think you could operate the treasury with 70,000 people, and I think no problem. I think no problem. So so again, I think that a lot of this stuff is overblown, and we do need this. We need this, and I keep going back to these numbers. U.S. debt clock, $36 trillion in debt. We have to shrink the size of government. Okay, more taxes coming in gives lets the government work more efficiently, which means we're not running $1 trillion deficits every year. The size of government has to shrink. I understand it's going there. I understand there's going to be some pain. I understand some people are not going to like it. I understand that it's going to cause a little bit of chaos, at least in the mainstream media's eyes, in the short run. But we need this. We have to do it. And if I truly thought that the government could not reduce a significant number of their workforce, like anywhere from 10 to 20%, if I didn't think that that was possible and the government could actually run and continue to run very well, yeah, I would be screaming from the high heavens. I'd be like, yo, this is crazy. We can't do this, whatever. But everyone knows that the government is massively bloated. Everybody knows this. That's been an open secret. Every politician, every administration has known this but beyond my entire lifetime. Okay, for the last 60 years, 70 years. Everybody has known that the federal government is just overly bloated, and yet they keep growing that bad boy. Here, you know what? Here, right here. If anybody's ever seen this, but hold on a second here. Anybody ever seen this book? Crisis and Leviathan. Robert Higgs, the classic. Critical episodes in the growth of American government. Okay, Crisis and Leviathan. This book is an all-time classic. I have to review this because this book basically says it explains why we kind of lurch from crisis to crisis, and yet the government just keeps getting bigger and bigger and bigger. That's why it's called Crisis and Leviathan. So because the government is basically the government is the Leviathan, if you will. Okay. Let's keep rolling on here. So Dollar Tree. I had to include this site. I just thought this was wild. Dollar Tree says it's winning over higher income shoppers and may offset tariffs with price hikes. But that's not the real story here. I want to go down here. What the real story here was that Dollar Tree dumped Family Dollar. The retailer weighed in on higher income customers and the potential effects of tariffs as it announced its fiscal fourth quarter earnings. Dollar Tree also said it will sell its struggling Family Dollar chain for about $1 billion to a consortium of private equity investors. Now, I don't know if it says it in here, but they paid like $9 billion, I think, for Family Dollar, and now they're dumping it for $1 billion. Like, I mean, you talk about a massive, horrible investment. I mean, wow. And they try to sugarcoat it in this article with, oh, well, we're catering to different, customer groups, and we're, it goes like this. Here's the press conference right here. Well, we're doing great. We're winning over more high-income shoppers during a sustained period of high inflation. And we think that we're going to be able to increase prices to offset this tariffs. And oh, by the way, we sold Family Dollar for $1 billion. Anyway, thanks a lot, everybody. See you later. That's how like pathetic this is. But it's fascinating though, because we just saw Walgreens, which was a high flying stock, top of the world. And now all of a sudden, like, they got sold for next to nothing to a private group a couple weeks ago. And I'm just sitting here looking at now Family Dollar, Walgreens. I'm looking at this pattern here and I'm just going, what is going on here? That, some of these companies are getting literally dumped for nothing. And it's just a very interesting pattern. And I like I said, I point this out because I'm really curious. I would really like to see if this trend continues throughout the rest of the year. If we start seeing a few more of these companies like this getting dumped for next to nothing, but we'll see. Okay. As I promised a few minutes ago, is everybody ready? So this is going to make Jeremy Powell very happy. His bestie, Grandma Janet, former Treasury Secretary Janet Yellen, to join Global Advisory Board for bond giant PIMCO. Yes, the former Treasury Secretary Janet Yellen will be joining an advisory board for bond giant PIMCO. CNBC has learned the advisory board members' mission, according to the PIMCO website, is to contribute their insights to the firm on global economic, political, and strategic developments and their relevance for financial markets, while at the same time being paid a lot of money and keeping the grift going no matter what. All right, I added that last part in there. So, yes, Grandma Janet apparently, running around and collecting $7 million in speaking fees before she became Treasury Secretary under Biden. Apparently that wasn't good enough. And apparently, she's not quite old enough yet. She's getting tired of sitting on the porch with the grandkids, knitting some sweaters. So she had to come back, man. She had to come back. She had to get, and you know what? She didn't get on the board of a nonprofit. She didn't get on, she didn't, donate her services somewhere or try to help some people that could have really used that massive depth of years of experience and knowledge that she has. Nah, screw that. She went to the PIMCO board so that she could continue making a ton of money and, and reaching in the pocket, grabbing the golden goose yet again, as they say. So, yeah, but I'm sure this makes Jeremy Powell very happy. He should polish up his resume because he can join her in about another 18 months. He can go join her and they could be, the besties there. And who knows, maybe Ben Bernanke can jump in on there too. Maybe he could jump in on the board and they can reunite the three amigos and maybe they can ride off into the sunset, all being board members at PIMCO. So, but I kid, we love Grandma Janet. We love her. Okay, so let's talk about tariffs here for just a second here. So Trump says that there will be flexibility on reciprocal tariffs. So President Donald Trump said there will be flexibility on his reciprocal tariff plan, even as he seems to oppose the idea of making exceptions for the forthcoming duties. Trump insisted that he did not change his mind when he gave top automakers a 1-month exemption on a prior round of import duties. Trump also said he plans to speak with Chinese President Xi Jinping. Now, I'll have more on that, Mr. Xi Jinping, in just a few minutes. I got some articles on that, so stay tuned for that. So President Donald Trump on Friday, this being last Friday, said there will be flexibility on his reciprocal tariff plan, even as he seems to oppose the idea of making exceptions for the forthcoming duties. People are coming to me and talking about tariffs, and a lot of people are asking me if they could have exceptions, Trump told reporters in the Oval Office. And once you do that for one, you have to do that for all, he said. Trump, an avowed fan of tariffs, also insisted that he did not change his mind when he gave top automakers a 1-month exemption on a prior round of import duties in early March. I don't change, but the word flexibility is an important word, he said. Sometimes it's flexibility. So there will be flexibility, but basically it's reciprocal. Trump has hyped the April 2nd start date for his reciprocal tariffs as America's Liberation Day. So here's the thing. You have to read between the lines on this a little bit. So what does he mean by flexibility? I think what he's saying there is he is signaling to other leaders around the world that, hey, I'm going to hit you with this tariff. But if you would like to come back and negotiate with me, if you would like to play ball, I can be flexible and we can work something out. And I believe that is the message that he's trying to send there in terms of flexibility. He's basically saying like, hey, look, I'm only going to slap this tariff on if you are not willing to come back to the table and make a deal with me. Okay. I think that is really what he's trying to say there. That if, hey, Canada, Mexico, EU, if you're listening, okay, in case you didn't know this, okay, because, I've known this for my whole life watching Donald Trump. If you didn't know this, Donald Trump's a deal maker. He's a deal maker. If you show up and you talk to him nice and you negotiate a little bit, guess what? You could probably almost 99% guaranteed you'll be able to work out a deal with him. So, so instead of being a moron, maybe go sit down, maybe call the White House and say, hey, can I come over and talk to the president for a few minutes and maybe work something out? But I think that is, like I said, that's my take on it. I think that's the message there. The message is come to the table and we'll negotiate and we'll work something out that hopefully will work for everybody. Okay. The eyes of the Fed are on tariffs. So what does this say here? So the Federal Reserve officials said this week that they are wary of tariffs' effect on the economy and are waiting to see how they turn out before adjusting monetary policy. Tariffs could push up prices, stoking inflation, but also could drag down the economy, hurting the job market. Both risks would call for opposite responses from the Fed, which can boost the economy or throw sand in its gears by adjusting the Fed funds rate, which affects borrowing costs. So again, this is the Fed. This is Jeremy Powell signaling that I'm not going to do nothing. I take my ball. I'm going home. I'm just going to sit here on the sidelines, and I'm not going to do jack. And I'm going to sit here because there are, like I said last week, there are things that the Fed can do to help the situation other than just simply decreasing interest rates. They have all kinds of things in their toolkit for helping to, massage the economy, so to speak. And yet we saw all that over the last 15 years. We saw them get massively creative with the QE, the quantitative easing, the quantitative tightening, Operation Twist, all these different things that they did. But now all of a sudden that Trump's back in office, they've all gone brain dead. They can't think of a single thing to do. All they can think to do is just sit over here and pout with their sad whip, and they give the sad whip. We're sad. Jeremy Powell has the sads. He can't go on. So, and here's the other thing. You're not going to have inflation continuing to take off and the job market in the toilet. It's not going to work like that. If the job market does fully go into the bad spot, then inflation is going to come down with it, or if the job market remains or continues to strengthen, I'll put it that way. If it continues to strengthen, then yeah, inflation may go up. But those things are going to go, I believe, with each other. They're not going to go in opposite directions. So, all right. So just to recap some of this stuff. So what do we have? We have inflation still a little bit high. Consumer sentiment, consumer confidence is going the wrong way. People, CFOs or, some corporate people are basically starting to say that they could see a recession coming on the horizon here in the second half of the year, basically toward the end of the year. President Trump says they are sticking with the tariffs, but he could be somewhat flexible with the tariffs. And the Fed is going to sit here and do nothing. So that's the basic recap of what we've gotten and what we've gone through so far in a nutshell. Okay, so let's go to just what were some of the media, just kind of, media stories or whatever that happened this week. So we had this. Trump media stock surges on plan to work with Crypto.com to offer ETFs. So I thought this was very interesting. So Trump Media and Technology Group is partnering with Crypto.com to offer exchange-traded funds to investors. ETFs are expected to be made up of cryptocurrencies and securities with a Made in America focus. The plan is set to launch later this year. So shares of Trump Media and Technology Group surged 9% Tuesday, a day after President Trump's social media firm teamed with cryptocurrency trading platform Crypto.com to offer exchange-traded funds. The operator of the Truth social site, the Truth Plus streaming platform, and Truth.fi financial technology brand announced that the products would be launched later this year through Truth.fi. Made in America focus. So the agreement calls for the ETFs to be made available through Crypto.com's broker-dealer Forest Capital US LLC and are expected to comprise digital assets as well as securities with a Made in America focus spanning diverse industries such as energy. Trump media said the offerings are to include a unique ETF basket of cryptocurrencies incorporating Bitcoin, Kronos, and other crypto assets. Trump media CEO Devin Nunes explained that the aim is to create inventive funds incorporating firms that concentrate on rapid growth, technological innovation, and strengthen the U.S. economy. So very interesting there. And I've got some, other news here. So Trump-backed crypto bank joined stablecoin wars with new dollar-pegged token. So World Liberty Financial, the decentralized finance venture backed by President Donald Trump and his family, has launched a stablecoin. So the stablecoin dubbed USD1 will be pegged to the US dollar and will be backed by short-term US government treasuries, US dollar deposits, and other cash equivalents. It joins an increasingly crowded market of stablecoins. The market cap for dollar-backed stablecoins has grown more than 46% in the past year, according to Crypto Quant. So on the one hand, we have the Trump media group basically working with Crypto.com to create this kind of, crypto ETFs with this basket, which one of the things it's going to have is a stable coin. And then we have this World Liberty Financial, the decentralized finance venture backed by the Trump family, basically launching a stable coin dubbed USD1. So you could kind of tell where that USD1 is going to go. It's going to go into this crypto basket. So, let's see here. The company said Tuesday that the stablecoin dubbed USD1 will be pegged to the US dollar and be backed by short-term US government treasuries, US dollar deposits, and other cash equivalents. It will soon go live on the Ethereum and Binance Smart Chain networks. USD1 provides what algorithmic and anonymous crypto projects cannot: access to the power of DeFi underpinned by the credibility and safeguards of the most respected names in traditional finance, said World Liberty Financial co-founder Zach Witkoff. We're offering a digital dollar stablecoin that sovereign investors and major institutions can confidently integrate into their strategies for seamless, secure cross-border transactions. The development comes as the market cap for dollar-backed stablecoins, cryptocurrencies that promise a fixed value peg to another asset, has been climbing to new all-time highs this year and has grown more than 46% in the past year, according to Crypto Quant. The market has long been dominated by Tether, USDT, and more recently Circle's USDC. So, yes. And then here we have stablecoin market capitalization, April 2024 through March of 2025. Here's a bunch of different stable coins in the group here, as it were. So, and then I think I got one more crypto, and this is mainly just a headline. So Sol, S-O-L, Sol climbs as BlackRock expands its 1.7 billion tokenized money market fund to Solana. So CNBC, Crypto World. So it just says here on today's show, Solana's SOL token climbs as BlackRock expanded its 1.7 billion tokenized money market fund to the network. And this says, plus President Donald Trump's crypto project, World Liberty Finance, launches a stablecoin, while Trump media shares jump following announcement of a deal with Crypto.com to launch ETFs and related products. So, interesting stuff happening there. A lot of interesting stuff happening in the crypto world. Let's see here. All right, I'm going to come back to this in just a second. Can I find, there was one more crypto related thing that I had, and here it is. So let's go. And I thought this was kind of funny. So on Friday, I'll get back to my in a couple minutes, I usually do my review of the episodes I put out this week, but on Friday, yesterday, I put out another episode in the crypto series. And one of the things I covered was how Sam Bankman-Fried basically did an interview with Tucker Carlson last week, and he was trying to get a pardon from Trump. Well, it was really funny to me because the first thought that came to my mind was, I was like, how is this dude doing an interview from prison? Like, isn't that, I'm pretty sure that's against the rules. You can't be doing interviews while you're in prison. And sure enough, it turned out that he, the prison didn't know he was doing this interview. This was a violation, and so Mr. SBF has found himself. He's now in transit. He's getting, it says, convicted cryptocurrency tycoon was at a transit facility in Oklahoma City that often houses inmates being moved across the country. So yes, they were a little mad at SBF, and they have decided to move him out of New York. But here was the funny part. Where do they say? Yes, it says, okay, so Federal Bureau of Prisons website showed early Thursday that Bankman-Fried was at a transit facility in Oklahoma City that often housing inmates being moved across the country. Until Wednesday, he had been at the Metropolitan Detention Center in Brooklyn hanging out with Diddy, where he recently recorded an unsanctioned jailhouse video interview with Tucker Carlson, part of a long shot bid to win a pardon from President Trump. A lawyer for Bankman-Fried didn't respond to a request for comment. But here's the funny part. So Bankman-Fried was awakened by prison officials at around 3 a.m. Wednesday morning and taken out of his unit at the Brooklyn MDC. Person familiar with the matter said, adding that the officers didn't tell him where he was going. A spokesperson for the Prisons Bureau declined to comment. The 33-year-old FTX founder's legal team has pushed for him to serve out his sentence in California so he can be closer to his parents' home near Stanford University. The Bureau's website shows that Bankman-Fried has a release date of November 17, 2044, meaning he's set to serve a total of just over 21 years. He was sentenced to 25 years in prison. But so I doubt he's ending up in California. I think that this is they're just messing with him. I think they probably will move him around a little bit. But I just thought it was funny that I had this thought in my mind that I was like, yeah, how is this dude doing interviews from prison? Like how is that happening? And it turned out that he did it on he did it through his lawyer. So he used some secure link, like some kind of Zoom connection or something that his lawyer was able to give him. And then he basically rolled, and then he, got connected with Tucker and did the interview from there. But obviously the prison system, not real happy with Mr. Bankman-Fried right now. And so that unfortunately blew up in his face, and he is now getting moved around. And we don't know as of yet where he will end up. But he is no longer hanging out with Diddy in New York. He is now somewhere traveling across the Midwest. So, okay, let's get back to this for a minute. Tax revenue collected by the IRS set to plummet, report says. So IRS officials are expecting tax revenue to drop by more than 10% by April 15th, the Washington Post reported. Officials said the prediction is directly linked to shifting taxpayer behavior and President Donald Trump's cuts at the IRS, the paper said. Officials at the IRS and Treasury Department are anticipating tax revenue to drop more than 10% by April 15th compared with last year, the Washington Post reported Saturday, citing 3 people with knowledge of the situation because, we should always believe the Washington Post. The loss of tax receipts is expected as more individuals and businesses don't file taxes or attempt to avoid paying balances owed to the IRS. The amount of lost federal revenue could top $500 billion, the paper said. Officials said the prediction is directly linked to shifting taxpayer behavior and President Donald Trump's cuts at the IRS. Thousands are expected to lose their jobs as the agency is part of Elon Musk's Department of Government Efficiency spending reductions. I think this is total, BS. Just like the FHFA, article that we looked at a few minutes ago, this is the same nonsense, oh, well, people are going to stop paying their taxes because, Donald Trump and Elon, they're going to reduce the size of the IRS. They're going to cut thousands of employees from the IRS. Therefore, in all that confusion, people are just going to stop paying their taxes. Like it's ridiculous. It's stupid. It's like, again, just like with the FHA, it's like, oh, well, because they're reducing employees means that they're going to start messing with the loan levels and what is what's the standard, loan amount that people could get for a normal mortgage. Like, it's like, no, they're like, one has nothing to do with, has absolutely nothing to do with the other. And, so again, I think the Washington Post is, I'm going to say that I think they're full of it here. I think this is a nonsense article. And we'll see. Let's give it a few months and see what happens. But I'm willing to bet that there's not that much change. Okay, so I want to get in and cover a few banking articles now. Because I want to show you guys a few things. I did an episode. Let me see here. What was that episode I did on de novo banks? Uh, do, 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 do. Yeah, so basically, I did a couple weeks ago. I did episode 343, which is "Can Congress Jumpstart De Novo Bank Activity?" And I just talked about, de novo bank activity, which is basically startup banks. I talked a lot about that in the episode, just explaining, what the trend has been the last couple of years. There have been hardly any de novo bank startups the last, 4 or 5 years. A lot of it, at the heart of it, it has to do with regulation. And I went back, and I went back to the Great Recession and talked about how in 08, 09, basically all these trends started. Sorry. And we just haven't seen a whole lot of de novo bank activity since then. So now I just wanted to touch on that a little bit here, but hold on, let me just jump. Where am I at here? What is that? Okay. All right. Yeah. So we'll come back to the China stuff in just a second. I just want to do this first. So 4 articles here, I think all kind of tie in and kind of paint a picture of what's going on with de novos and what's going on with the merger and acquisition market in banking right now. So this article basically says number of new U.S. banks continues to decline in 2024. So the establishment of new banks dwindled in 2024 due to high capital requirements, an unfavorable interest rate environment, and regulatory scrutiny discouraging investors. Only 6 new banks were established in 2024, following another slow year in 2023 when 8 banks were formed. There were 16 de novo banks in 2022 and 9 in 2021, according to S&P Global Market Intelligence. So, and then here from this chart here, you can see, and this also paints like how many banks are profitable versus not profitable. No quarters of profitability yet. So obviously, banks that just started aren't going to be profitable just yet. It usually takes a minimum of about 3 years for a bank to get to profitability. So, like, I would expect, like, this bank here, there's one bank here in 2021 that's yet to be profitable, and 9 banks here in 2022. So I would expect probably by the end of this year that these banks will all probably become profitable, and then these banks will follow shortly in the next year or two. But this just go. I mean, these numbers are minimal. I mean, these are minuscule rather. I mean, you look at 13 in 2019, and then 5 in 2020, and 9 in 2021, and 16 in 2022. Again, these numbers might sound like a lot, but if you go back to, say, the period from like 1996 until about 2007, you're talking about 150, 200 new banks a year. Starting new banks was a great business. But it had since 08, 09, it has not been so. And since the Dodd-Frank Act came in 2010, that changed the game. It added a ton of regulation, added new capital requirements, added all kinds of stuff. And so the number of de novo banks is they got to do something to get this going again. But let's keep going here. So Battle Financial seeks a speedier bank charter process with community bank deal. So Edwards, Colorado-based Battle Financial Inc. pivoted to M&A to jumpstart its national bank plan after the de novo route proved to be a long and winding road. So Battle Financial plans to acquire Upsala, Minnesota-based Stearns Bank Upsala N.A., which had $64.4 million in assets as of December 31st, 2024, and launch its national banking plan under the Battle Bank NA brand name. The announcement of the acquisition came after the July 24th, 2024 expiration of the conditional approval Battle Bank secured from the Office of the Comptroller of the Currency for its charter application. The company's management decided an acquisition, as opposed to a de novo, would be a more cost-effective way to achieve its business plan. So, and again, in that episode, this is kind of what I talk about. I talk about how, because it's so hard to do a startup bank, do a de novo bank, and get a bank charter, that basically a lot of banks have said, you know what, let's just go buy a small bank that already has a bank charter, and we'll just do it that way. So this was a perfect example of that. And And they just say here, like, we decided it would be much more expeditious to go the route of purchasing Stearns Bank of Uppsala. Trotter said in an interview, raising capital is a challenge all de novos face. In Battle Financial's case, the banking watchdog approved its charter application in October of 2022 on the condition that it would raise $120 million. That's a huge capital raise. Like, the minimum amount that I don't know why their capital raise was so large. Maybe it had to do with maybe because they wanted to go national and they had major growth plans or growth strategy. So maybe that had something to do with it. But the minimum amount you usually have to raise is $20 million. So for them to ask them to do $120 million, that is an enormous capital raise. So Trotter said Battle Financial was making progress in its capital raising goal. However, the executive noted the environment kept fluctuating. At times, the market was buoyant, and other times it was impacted by issues related to the pandemic and the liquidity crisis that led to some massive bank failures in 2023. Each period has its opportunities and challenges. So, and then they talk about de novo hurdles, the battle plan. So it's it's just, like I said, interesting scenario. And then we go to Florida de novo, Bank Miami bullish on growth. So a growing market and favorable economic conditions give Bank Miami executive confidence in the de novo's outsized growth plan. So Coral Gables, Florida-based Bank Miami aims to grow assets to north of $400 million by the end of its third year after opening on March 17th with assets of $30 million. Its rise will piggyback wider expansion in Miami. President and CEO Mary Usategui, sorry if I'm not saying that right, said in an interview, we have pretty aggressive growth plans for de novo banks, she said. But if you look at some of the other de novo banks in the state of Florida, this is achievable in different markets that aren't even as flourishing as Miami-Dade County. So we're very bullish that we can exceed what we're doing. So, So they see a niche. The company seeks to take advantage of a huge void in the market for banks targeting smaller customers with complex needs that could be overlooked by larger institutions. There used to be a handful of banks that played in this space, and due to how profitable they were and due to the market share they had, bigger banks and banks out of market that wanted to enter the Miami-Dade market ended up gobbling them up. Bank Miami picked up employees being let go from Usategui's former employer, Professional Bank, where she had been the CFO. After that company was acquired by Seacoast Banking Corp of Florida in January 2023. Seacoast Banking, great bank down there in Florida. They have been making acquisitions like crazy. I think they've done something like 15 acquisitions in the last 10 years or 15 years, something like that. I mean, so that's basically like an acquisition a year. I mean, they're just... they're buying all kinds of stuff down there. But again, so here we had Battle Bank, which basically gave up on the de novo thing and just said, okay, we're just going to buy a small bank to get the charter. And then we have this Bank Miami, a full-blown startup in Miami that feels like they've got a little niche going there and that they're going to be able to get this thing rolling. I think $400 million in assets, and after only 3 years, I mean, that's a pretty lofty goal. I applaud them for that. But, we'll see. And then here's our fourth one. So Cadences, I think I'm saying that right. Cadences speedy deal approval signals softer regulatory stance, Piper Sandler. So regulatory approval of Cadence Bank's acquisition of BCE Financial Corp in just 61 days is a good sign for the industry, according to Piper Sandler analyst Stephen Scouten. The fast approval suggests regulators may already be taking a more streamlined, constructive approach, Scouten wrote. Fewer regulatory hoops stand to be a positive for the industry amid pent-up M&A demand due to factors like aging leadership and increased technology cost. Cadence now expects its purchase of FCB Financial to close on May 1st, when the deal was announced. The bank said it would likely complete the deal in the third quarter. The approval is an unusually fast timeline when compared to recent transactions. While the deal is small, the speed is notable, especially with 2025 off to a slow start for bank M&A. So again, very interesting here. I mean, obviously 61 days is like lightning fast. I would not expect to see too many deals approved in 61 days. I mean, even on a normal basis, that's kind of wild. I mean, normally, these things probably take anywhere from a year to 18 months to get approvals and get consummated and all that kind of stuff. So 61 days is pretty, that's pretty wild. So, okay, we'll get into some of this bank. We'll get into some of this other bank news here in a second. I want to come back to this Chinese story here for a minute, because I think this is kind of important to talk about the whole, again, a little bit more on the whole tariffs angle. But okay, what I want to do for a few minutes is I want to talk about the episodes that I did this week. So I want to go over the 5 episodes I did this week. And then, I also want to do economic indicators coming up for next week. So let's do that real quick. So, okay. Monday, March 31st, we have the Chicago PMI for March. On Tuesday, April 1st, we have the ISM manufacturing PMI for March. We have the ISM manufacturing prices for March. And then we also have the JOLTS jobs openings. Then on Wednesday, April 2nd, we have the ADP non-farm employment change for March. We have factory orders for February. On Thursday, April 3rd, we have continuing jobless claims, initial jobless claims, trade balance, and ISM non-manufacturing PMI. And then finally, on Friday, April 4th, we have the average hourly earnings, non-farm payrolls, participation rate, unemployment rate, and then the U.S. Baker Hughes total rig count. So a lot of employment information this week. We got the JOLTS report, initial jobless claims. We got the labor force participation rate, the unemployment rate. So a lot of really good labor market. Maybe we'll get a little bit, see what's kind of happening with the labor market a little bit there. Maybe. Okay, so on Monday, I did episode 347, and I was very, very stoked about this. So I did an interview with Paul Davis from the Bank Slate. Now, Paul Davis, very well-known guy in the banking business. The guy has worked for American Banker. He's done things with the ABA Banking Journal. I think he's written stuff for anything and every. I mean, you name it. I mean, Forbes, Wall Street Journal. He's basically done it all. But a couple of years ago, he basically went out and started his own company called the Bank Slate. Now, the Bank Slate does a bunch of different things. They do research, they do strategic consulting for banks, but they also have a great website. They also put up articles. Paul does a lot of writing for obviously writes a lot of articles for a lot of publications, but he also does a lot of articles on Substack. I'm actually in an episode I'm working on for this week. I'm actually going to cover. We're going to talk about merger of equals in the banking business. I'm going to cover one of Paul's articles from Substack on a particular merger of equals transaction that happened recently. But I did this interview with Paul, and the reason why I called Paul to do this interview was because he had wrote an article in a publication called FinX Tech, which was titled Navigating Crypto in the Second Trump Era, where he lays out the pros and cons of banks getting into offering crypto-related products and services. So that was the main focus of our conversation, but we also discussed, recent updates in regulation and policy and weigh the potential risks and reward for banks in the crypto space. But like I said, I highly recommend everybody check that out. I'm hoping that I'm hoping that Paul will become kind of a regular contributor get him coming on every couple of months just to kind of talk about different things going on in the banking business. Then on Tuesday, I did episode 348, How Quickly Should Banks Move into AI? So this episode examined 3 articles from the Wall Street Journal. The first was The Rise of Artificial Intelligence at JP Morgan. The second was How the AI Talent Race is Reshaping the Tech Job Market. And the third one was Why Most Companies should not have an AI strategy. So, how quickly should a bank or any company for that matter move into the use of AI? What are some of the pros and cons? What is the largest bank in the US currently doing? How is the labor market currently being influenced by the AI craze? So I thought that turned out into a really phenomenal episode. So if you want to get a little bit more in depth on AI and kind of what's going on in banking, how is this being influenced by the labor market? And then ultimately kind of a devil's advocate, why banks or why companies shouldn't get into AI, which I thought was a great kind of look at that. Then on Wednesday, I did episode 349, which was CLOs, CMBS, RMBS, ABS securities are all hot again like it's 2008. So, and this episode examined a recent article from the Wall Street Journal titled, "They Crashed the Economy in 2008 and Now They're Back Bigger Than Ever." So remember collateralized loan obligations, CLOs, commercial mortgage-backed securities, CMBS, residential mortgage-backed securities, RMBS, and asset-based securities, ABS. For some of us, these products of financial wizardry still produce post-traumatic stress syndrome. I know they do for me. Well, they are back and bigger than ever. Is this a good thing, or should we all get ready for the next crash? So very interesting episode. Of course, everyone remembers the movie The Big Short. If you remember the at the end of the movie, when they get kind of all the characters together at the convention out in Vegas, the show that they went to is the exact same show that the convention that they went to out in Vegas was the exact same convention that is covered in this article of basically all these people in the securities industry. So again, check that. I thought it was an absolutely kind of wild episode, very eye-opening, and go check that out. And then on Thursday, I did episode 350, which was an update on the Synapse Financial Technology bankruptcy. So this episode provided an update on the financial technology, or just the Synapse bankruptcy, by examining two articles from the Wall Street Journal titled, "The Bank Behind the FinTech Revolution Stumbles After Customer Funds Go Missing," and "Synapse Executives Alerted Accountants Before $100 Million Missing Funds Scandal." So the first article explains how funds moved from fintechs to Synapse as the middleman to banks. The second article gives details of the grand jury that has been convened to investigate criminal misconduct at Synapse. So again, a lot of things happening because in the industry because of that Synapse failure. So it's a big story, and it's something that I want to keep an eye on and ultimately see, will we have criminal charges filed here? What ultimately happens? Are they going to go to court? We'll have to see how that, continues to play out. But there's a lot to be said about that in terms of, we had a lot of issues with that in terms of, managing third-party relationships, broker deposits. There was a whole bunch of things that happened out of that Synapse failure. And that's why it's important to follow the case and see what happens. And then finally on yesterday, I did episode 351, which was crypto scams, regulation, policy changes, and more. Crypto series part 18. So this was part 18 of the crypto series. In this episode, we review recent crypto-related stories, including updates on potential regulation and new guidelines from the OCC, crypto scams and fraud from jump trading to the crypto hack to Bybit to pig butchering in the Philippines and video games. We also look at MicroStrategy and how crypto can be vulnerable to a quantum hack. So that episode kind of ran the gamut and went kind of all over the place. So check that out if you have a chance. So, okay. So those are the 5 episodes from last week. So, okay. I wanted to share this with everybody for a second. I could not believe this. When I saw this week, I was kind of dumbfounded because I knew this was coming. And so private credit, if everybody remembers me talking about private credit over the last months and years, I basically said if there was a bubble that was going to burst, or if there was going to be the next crash coming up, it was going to be in private credit. And private credit is run mainly by private equity, massive hedge funds, and these guys were buying up all these loans from banks. They've turned this into like $1 trillion industry, and if this thing blows up, these hedge funds and private equity are not banks. So right now, there is technically no way for them to be bailed out. However, that I just said that. So I read this. I cannot believe I read this week. A panel of financial experts are urging the Federal Reserve to establish an emergency program to manage highly leveraged hedge fund trades in case of a crisis in the U.S. Treasury markets. Wow. The Federal Reserve should consider putting up an emergency program to handle highly leveraged hedge fund trades in case of a crisis in the $29 trillion U.S. Treasuries market to cushion the shock for bond dealers. Bloomberg News reported, citing a Brookings Institute paper authored by former Fed Governor Jeremy Stein of Harvard University. Anil Kashyap of the University of Chicago, Jonathan Whalen of Harvard Business School, and Joshua Younger of Columbia University. I mean, just wow. I mean, let me read that again. So a panel of financial experts are urging the Federal Reserve to establish an emergency program to manage highly leveraged hedge fund trades in case of a crisis in the U.S. Treasuries market. Now, what do they know that we don't know? Why would there be a crisis in the Treasuries market? Why would hedge funds be involved? Perhaps I will have to find this, paper, if you will. I will have to find this paper and find out what the deal is here. But I could not believe it. My jaw almost hit the ground when I saw this, because I basically said, unbelievable. So if you read between the lines and you understand what I just read, what that is saying there is basically like, we know that hedge funds and private equity are about to blow up, and we need to have the bailout ready to go. We need to have the bailout ready to go to catch these guys when this inevitable implosion comes. And I sometimes I hate it when I'm right. Sometimes I hate it when I'm right. Now, there are people out there who will say, "Oh, no, that's not true. That's not true. These are just these guys being prudent, or they just want to prep for something that may happen, but there's no guarantee it's going to happen. Whatever." Yes, I'm too skeptical. I've been around too long. I've seen too much. Lived through all kinds. I've lived through .com bubble burstings, great recessions, pandemics. Market crashes, bank failures. I have seen it all in the last 25 years. And I'm not, I know the game, and I see how this is played. And I'm telling you, that is highly disturbing. So I'm going to go track down this paper from the Brookings Institute, and I'm going to review this, and I'm going to bring this back to everybody. And hopefully I could bring it back next week, but we shall see. But I had to report that because I was blown away when I saw that this week. I just absolutely floored that I just could not believe what I was reading. I had to read it like 5 times because I was like, I can't believe I'm actually reading this. After everything I've said and warned about over the last year, what's the word? The flabbergasted, just absolutely flabbergasted. I couldn't believe it. But anyway, all right, let's get back to some articles now. Because I still have a ton of stuff here. I don't know if I can get through all this stuff here in the next 30 minutes, but we're going to try. All right, guys, so let's talk about China here for just a minute. I got 2 articles here on China. Want to talk about this. So Chinese megabanks expected to post 2024 earnings dip amid margin pressures. So 3 of the 4 Chinese megabanks, the biggest lenders in the world by assets, are expected to post declines in net income for 2024 due to shrinking net interest margins. Annual net profit at Industrial and Commercial Bank of China, the world's largest lender by assets, will likely decline 2.2% year over year to 355 billion won in 2024, according to the mean estimate of the analysts who shared their forecast on the S&P Capital. Bank of China's net profit will likely decrease 1.8% to 227 billion won, while Agricultural Bank of China's net profit is expected to slip 0.8% to 267 billion won. China Constructed Bank Corp could be the exception, with an expected 0.6% increase in net profit to 329 billion won. The banks are due to report their 2024 earnings toward the end of March. Analysts expect lender profits to regain momentum in 2025, even though net interest margins, a key component of interest income, might continue to edge lower, according to estimates. So, for anybody who doesn't know, China's economy has really been taking it on the chin. They're actually in the midst of a potential major deflationary spiral. Their real estate market has totally imploded. And it's tough, because I don't believe any of the numbers that come out of China. I just do not believe them, because they just, China just, they BS us up and down all over the place. They never give us the right story. They kind of have to report this stuff because they know that if they were reporting that everything was fine and they had profits and everything else, and nobody would believe that. So they gotta try to doll it up a little bit, spray paint the pig, if you will, and basically say, yeah, it's not too bad or whatever. But here's the real tell of the tale right here. So this article was in the Wall Street Journal this weekend, and this is Xi's message in rare meeting with global CEOs, defend trade. Globalization is, wait for it, an unstoppable historical trend. Chinese leader tells foreign business people. Okay, this is what you call total panic. Okay, this is what you call total panic. First of all, Xi would never go to one of these meetings and pitch these foreign business leaders himself, let alone try to hold up his Bible of globalization. Basically, it's an unstoppable historical trend. That this is a total desperation move on the part of Xi. So Chinese leader Xi Jinping urged foreign business executives to defend trade and said globalization was unstoppable, drawing an implicit contrast between Beijing's policies and President Trump's tariffs. In a rare meeting, as in never, the Chinese president summoned a who's who list of foreign executives from the likes of Pfizer, Blackstone, and Mercedes-Benz to Beijing's Great Hall of the People on Friday. First of all, I have a major issue with the CEOs and high executives of companies like Pfizer and Blackstone and Mercedes-Benz getting called to the Great Hall of the People, like a bunch of lapdogs, okay, and running over there to their Chinese paymasters. That extremely bothers me. That's a whole. I digress. I mean, that's a whole nother conversation that we need to have on this. But I digress. Let's keep rolling here. So, globalization is an unstoppable historical trend, Xi said, according to the state-run Xinhua News Agency. So multinationals should import responsibility in maintaining the world's economic order, he told the room of about 40 executives and business group leaders from the U.S., Europe, and Asia. He also assured them China was open for business and eager to help foreign companies thrive. The charm offensive by Beijing toward Western companies over the past week has included tentative steps at diplomacy with the U.S. on Sunday. Chinese Premier Li Qiang met with Trump ally Senator Steve Daines, and Daines said the meeting laid the groundwork for an in-person summit between President Trump and Xi. Beijing's recent messaging, including at an annual forum for global executives that concluded Monday, presents China as an anchor of stability in a tumultuous world and seeks to turn foreign business leaders into allies in the fight against Trump's tariffs. Since he took office in January, Trump has raised tariffs twice on Chinese goods, which now face additional 20% levies on top of earlier tariffs. Both times China has retaliated. Still, some participants at the earlier forum said it was clear that China's openness had limits. Beijing's drive for self-sufficiency in technology and other industries has created a skewed playing field, they said. An increase in competition from local rivals has also eaten away at foreign brands' market share, for example, in cars. So China has put themselves in a massive box here. And don't think for a second that this Chinese mega banks posting bad earnings, don't think for a second that this does not have to do with this. Okay, these things go hand in hand. Z is running in there, okay? He's calling people to the carpet basically because he has got to hold on to this idea of globalization, because China is at the very heart of that globalization, okay? If people are not having their manufacturing done in China, okay, it's going to kill them. However, China wants to rule the world. They want to dominate everything. So they are, so when companies come over to manufacture in China, China gets to own a piece of the company, if not the majority of the company. They have to share all their intellectual property with China, who then just steals said intellectual property and runs it down the street and just recreates it and starts selling it to themselves to everyone else around the world. So I don't know why anybody would ever want to do business in China. I really don't. And then on top of it, this deal was great, 25, 30 years ago when the cost of, because, hey, look, Nike loves themselves some China slave labor. They can't get enough of it. So, but when it was a lot cheaper over there, it made a lot more sense. But the cost of wages in China has gone up. I mean, as their economic standard of living has gone up, so have their wages. So, it's not as cheap over there. A lot of companies have actually looked at places more like Vietnam and Cambodia and Thailand as more viable alternatives as opposed to China, just in terms of the amount of wages that people are paying. So, so this is total panic. This is total panic on the part of Xi coming in here. And, this is him basically like, oh, crap, we are in big, big trouble because if the U.S. decides to tariff us to death, our economy is already in the toilet and it will literally cripple our economy. So, so again, very important things to pay attention to here. So, okay, so let's continue on with our bank articles here. So a couple more things. So the U.S. Small Business Administration restores lender fees to the 7A loan program. So the U.S. Small Business Administration restored lender fees to its 7A loan program with plans to announce additional changes over the coming weeks. The core 7A lending program recorded negative cash flow of about $397 million in 2024, marking the first instance of negative cash flow in 13 years. The SBA estimates that over $460 million in upfront lender fees were not collected from 2022 to 2024. Lender fees were waived under the Biden administration, according to the release. To safeguard taxpayer-backed capital and small business formation, the SBA is taking immediate action to reverse these policies, starting with the restoration of lender fees to protect the future of the program. So, so again, good news there. This was an interesting article. So history's largest sports deal also offers a market-beating return. So for anybody who doesn't know, anybody who doesn't really follow sports, so the what was it? So the Boston Celtics were sold in the largest deal in sports history with a price tag of $6.1 billion plus potential earnouts. The acquisition of the most decorated basketball franchise in the U.S. provides a market-beating return to previous owner, Wyke Grousbeck. So, just absolutely crazy. And then they detail out a whole bunch of other sales that were done here. So like the Boston Celtics, Paris Saint-Germain, Dallas Mavericks, these are all more recent sales. And it basically says what they were originally purchased for. So like the Dallas Mavericks here were purchased in 2000 for $285 million. And then they were sold in 2023 for $4.5 billion. So a 1,487% growth rate with the CGAR of 12.7%, just phenomenal. The Ottawa Senators, Baltimore Orioles, Washington Commanders were previously sold in 1999 for $750 million. Then they were sold in 2023 for $6 billion. Just unbelievable. Denver Broncos, 1984 sold for $78 million. 2022 sold for $4.6 billion. Like, it's just, these numbers have just become so eye-popping. It's just astronomical. It's just crazy. And it's just like I said, I wanted to show this just because it's interesting when you actually see these together like this, when you see a number of these transactions together and you realize that like these sports franchises are all selling for, first it was in the millions, then it was the hundreds of millions. Now it's literally billions. Every one of these franchises, Boston Celtics, $6.1 billion, Saint Germain, $4.2 billion, Dallas Mavericks, $4.5 billion, Chelsea FC, $2.5 billion. Ottawa Senators was only $950 million, but Baltimore Orioles, $1.7 billion. Washington Commanders, $6 billion. Milwaukee Bucks, $3.5 billion. Denver Broncos, $4.6 billion. Phoenix Suns, $4 billion. Look, I know that the Boston Celtics are the most decorated franchise in the NBA. They've won 18 championships. That being said, I have a very hard time believing that the Boston Celtics are worth more than the Denver Broncos and the Washington Commanders. I just have a really hard time believing that they're worth $6.1 billion. Yeah, it's just mind blowing. But anyway, I thought, like I said, thought it was interesting. Thought people would find that one interesting. Um, Okay, tighter U.S. immigration policy likely to cool domestic job data. The Trump administration immigration policy shift has caused a steep decline in potential workers coming into the U.S. and will likely trigger a near-term drop in domestic job growth, economists say. In the early days of his second White House term, President Donald Trump declared a national emergency at the southern border and issued executive orders aimed at enhancing vetting of border security, visa applicants, asylum seekers, refugee programs, and more narrowly defining the right to citizenship for those born in the U.S. These actions will likely be reflected in labor market data, potentially in the government's March jobs report set for release on April 4th, said Julia Pollack, chief economist at ZipRecruiter. She said declines in movement across borders will likely stall U.S. job growth and could weaken key portions of a U.S. labor market that has remained surprisingly resilient in spite of the relatively high interest rates and recession fears. Yes, but I would also say there are about to be a ton of government employees that are going to be looking for new employment here very shortly. So I am sure that some of those recently unemployed government employees will be happy to fill some of these positions. So I think it'll kind of balance itself out at the end of the day, actually. Okay, the BAAS community banks with enforcement actions underperformed peers in 2024. So, U.S. banking as a service community banks operated under enforcement actions, underperformed compared with their peers in several fintech metrics in 2022. So, banking as a service. BAAS community banks with enforcement actions issued between January 1st, 22 and March 13th, 2025 reported higher net charge-offs and operating expense ratios, as well as lower returns on average assets and net interest margins in 2024 compared to BAAS community banks overall, based on median values according to S&P Global Market Intelligence analysis. These banks also booked a median decline in total deposits, total loans, and leases. So, yes, so it's just very interesting. So basically, the BAS banks underperforming. A number of these banks are under enforcement actions. We can see here, like Patriot Bank at Stamford, Connecticut. They have a formal agreement, consent order. Green Dot Bank, cease and desist. Evolve Bank and Trust. Now, Evolve Bank and Trust, obviously, majorly involved in the Synapse, failure. That's again part of the reason I did an episode on that. They're hit with a cease and desist order. Thread Bank, Piermont Bank, Sutton Bank, Lineage Bank, Blue Ridge Bank, Choice Financial Group, B2 Bank, Vast Bank, and Cross River Bank, all under former agreement and consent orders. So again, the BAS business model really kind of under attack at the moment. Not that this business model can't be a good business model. I think it can be, but I think a lot of these banks need to reevaluate. I'll say it like this. I don't know that this, like a lot of these, I think a lot of these banks were trying to be like, if I could use a phrase in the industry, one trick ponies. And they were trying to be, this is what they were going to do. They were just going to be BAAS banks. And I don't know that that's maybe feasible, at least at this time. I think it's more likely that if you're a bank and you offer BAAS services, that's probably the better business model, probably the better thing for the moment. So, but yeah, so we'll continue to take a look at that. So, okay, let's keep going here. All right, this was wild, man. I actually saw this morning, and my eyes bugged out of my head when I saw this. Not for the reason you may be thinking. University of Michigan guts DEI programs. Okay. Don't really care. Glad to see it. But here's the thing here's what killed me. What does it say underneath that? It says the university was estimated to have spent $250 million on DEI programs since 2016. $250 million. Let me say that again. $250 million on DEI. I mean, how do you look? So you're looking your students in the face and you're saying, we're going to spend this obscene amount. This is a college university. They're spending $250 million. That's like a capital plan for 10, that's like 10 years of growth at the university. Okay, 10 years of growth, new buildings, new programs, sports teams, all this stuff. Okay, and they decided to spend it on DEI, and they jacked up the cost of tuition on kids so that they could charge them to spend money on this crap. It's mind blowing. And then you think about how many universities out there have done this same thing. How many universities have spent? I think we need a full-blown study on how much money these universities have spent on this crap, okay? And I think that these universities should be forced, wait for it, to give this money back to the students, okay? If you went to school, if you were in there from 2016 to 2024 over that 8-year period of time, you should get some kind of rebate. You should get that 250 million should be paid back to those students, okay? Because this is that egregious, and I can't even believe it. I just can't believe it. But anyway, all right. Anyway, I got to move on from this one. Otherwise, I might just blow a gasket here. So anyway, okay. Some positive news here. I saw this was kind of interesting. So Mississippi governor signs law phasing out individual income tax. So new legislation cuts the individual income tax rate to 3% by 2030. After that, it will decrease every year until it is eliminated. So by 2023, Mississippi will no longer have an individual income tax. And I think they became the 10th state in the country that will no longer have an income tax. But that's pretty cool. That's pretty cool. It's pretty neat that they did that. Okay, so here's interesting news also that came out just yesterday or whatever. So Musk's AI startup is actually going to buy X, the X platform, in a $45 billion deal. So Elon Musk owns social media platform X has been bought by xAI, Musk's artificial intelligence company. So Elon Musk announced Friday that his artificial intelligence company, xAI, has acquired his social media platform X in an all-stock deal valued at $45 billion. xAI's and X's futures are intertwined. Today, we officially take the step to combine the data models, compute, distribution, and talent, Musk wrote on a March 28th post on X. This combination will unlock immense potential by blending xAI's advanced AI capability and expertise with X's massive reach. So very, very interesting. Just wanted to point that out. Okay, I'm going to cover this article in more detail in a future episode, but I just saw this again today in the Wall Street Journal. The secrets and misdirection behind Sam Altman's firing from OpenAI, the inside story of how the CEO of the hottest tech company was ousted and just as quickly resurrected. So this is a very interesting story from a number of angles. And like I said, I'm going to cover this because this needs more time. I probably need about 20, maybe 30 minutes to cover this. And so I'm going to do this as its own episode coming up here in the future. All right, we already covered Mr. Bankman-Fried. And here's another article: is recession coming? Many consumers think so. So, and again, this just goes over the stuff that we talked about: consumer confidence, consumer surveys, basically just saying consumer sentiment, consumer confidence, basically just saying that things are slowing down. Some people saying that they think that there could be a recession on the way. Gold rises as Goldman Sachs lifts year-end forecast to $3,300 an ounce. Just unbelievable. Gold continues to just power on here. So gold prices jumped Thursday after Goldman Sachs raised its year-end forecast for the commodity to $3,300 per troy ounce level. Analysts Lynn Thompson and Don Struven said the increased year-end target reflected higher than estimated inflows into gold by exchange-traded funds, as well as continued strong central bank gold demand. Gold, a safe haven investment, has benefited from investors anxious about escalating trade wars and the prospects for U.S. economic growth. So, yes, so we will have to continue to keep a look at the price of gold. I will have more information on gold. I actually have a lot of information that I've gotten from the World Gold Council and a couple other places. So I definitely have a lot of good gold related stories and info that I could share. So I will bring some of that back in the weeks to follow. Our workplace is getting more toxic. Some employees think so. So a new survey here basically said that a new survey dove into the effects of toxic workplace, with some 30% of employed Americans looking for work saying things are worse now than 3 years ago. Over 20% of employees surveyed said they've witnessed a rise in coworkers being mean to each other over the past year. Toxic workplace culture can lead to employees using vacation, personal, or sick leave to avoid it, according to another survey. So, yeah, well, I mean, have you seen politics lately? No, really a surprise there. All right, I'm going to skip that one here. Let's see what else we got here. Okay, Bank of America tightens oversight of junior bankers' hours. The bank also eliminated around 150 junior investment banking roles last week. So, in case anybody didn't notice, a couple of young investment bankers basically died. And over what, probably the last year, I think a couple of them died. But basically, a lot of people said that the heavy workload and the long hours that they work perhaps contributed to their demise. So this is something that, obviously a lot of people on Wall Street have been paying a lot more attention to. And people at the Bank of America stepped in and basically said, okay, we're going to start to try to rein some of this in a little bit. Instead of working 100 hours a week, they're going to let them work 98. No, I'm just kidding. I think they did hopefully a little bit better than that. All right, I had some other stuff. Let's see if we can. All right, I'll tell you what. You know what? I'm gonna go into wrap up mode here, guys. I'm gonna wrap this up. So let's do our couple things here. I got our story of the week, and then I've also got our quote of the week. So let's do that, and then we will wrap up for the night. So, all right. So our story of the week here, we're going to look at our event, if you will, is Black Thursday from 1929. So Black Thursday is the name given to an infamous day in stock market history. Thursday, October 24th, 1929, when the market opened 11% lower than the previous day's close and panicked selling ensued throughout a day of heavy trading. Black Thursday is considered the first day of the great stock market crash of 1929, which continued until October 29th. At the end of the day on October 24th, the Dow Jones Industrial Average had fallen 21%. Following Black Thursday's slide, the three leading banks at the time, Morgan Bank, Chase National Bank, which is now JP Morgan Chase, and the National City Bank of New York, which is now Citibank, put together a $750 million fund to support the markets. While this initially helped with the Dow recovering slightly that same Thursday and up higher the following day, it did not last long. Black Thursday was followed by Black Monday on October 28th and Black Tuesday on October 29th, with the Dow dropping 13% and 12% respectively. So there you have the story of Black Thursday, 1929. So, and then, and just so you know, so last couple of weeks, we did the bank panic of 1907. We did Black Friday of 1869. We did the first U.S. bank failure in March of 1809, and we did the first banking crisis of 1792. So we're kind of making our way through the history of the country with a number of these economic incidents. So, and then, okay. What is our quote of the day here? So our quote of the day: great fortunes are made when cannonballs fall in the harbor, not when violins play in the ballroom. And that was Nathan Rothschild, of course. Very interesting quote. Mr. Rothschild has many famous quotes, and I'll be sharing a few of those with you in the weeks to follow. But that was probably perhaps one of his more famous ones. Again, great fortunes are made when cannonballs fall in the harbor, not when violins play in the ballroom. Like, in other words, fortunes are made when war is happening, not when you have peace and love and prosperity. So I will leave you on that thought here. So I thank everyone for listening and tuning in for tonight. I think it was another great episode tonight. I thank everybody for listening. And I will say, hey, if you liked what you saw tonight, please make sure to like, share, and subscribe, as that really helps the channel. Still pushing to try to hit that 1,000 customer mark. So if you like what you're seeing, please help me spread the good news out there in the world. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments. As I always love getting back to everybody. I always love responding to everybody's comments, or at least as much as I possibly can. And as always, make sure to check out some of the other content on the channel. I'm always posting up one episode a day, Monday through Friday. Episodes are usually 10 to 15 minutes in length, so not that long. Don't take that long to consume. But like I said, check it out. I'm hoping I'm putting out really good topics. And also, if you ever have an idea for a topic, you could send that to info@thebankernextdoor.com. And bankernextdoor.com. And don't forget to check out the website. Don't forget to check out thebankernextdoor.com as well. Always making changes and updates to the website. So, make sure to go on and check that out as well. So, but with that, I bid everyone a fond farewell. Have a great weekend. And I will see you back here again next week. Same time, same channel. Have a great one. See everybody later.